Welcome to TradeTheNBA.com. This is John's reports for the 23rd. Well, not too shocking. We came up against that previous resistance level here of the ABM yellow, and well, it started to pop up. The early Fed minutes came out suggesting that the Fed recognizes the early AVs and realizes that there are some limitations to what they can do. The market wasn't too thrilled with it, but only modestly dipping right back to that 61% and actually still above that 55, 59 previous algo level. So the fact that it held up that well is pretty strong indication that they still think the Fed is going to be forced to do something as far as softening, but the extent of which probably will not meet the expectations of the market. C'est la vie. The revisions that came through with the jobs numbers and stuff just belie that none of what, if you even believe the adjustment. Of course, it's only the second worst adjustment ever, and I was fortunate that that did. But it was all pretty obvious. I mean, you add up the state unemployment numbers, and it didn't match what the federal numbers were. So, this is simple math. But nobody does that. They're just looking for headlines, and they understand the narrative wins, and uh, that's what we've been dealing with for quite some time. I mean, you have someone who's going to uh, become a part of the nominee for president and never having been voted by anyone. So that was an interesting one as well. So this is the system that has evolved. And from a market standpoint, at the end of the day, with inflation where it is, the market's not going to take that haircut, so we get a push to the higher values. But you see that the real problem the Fed is seeing now is that capex from most of these companies has been cut significantly, and when you're not promoting capital investment and just speculation, well, that has a net negative impact over time. And I think the Fed recognizes that. And so there's going to be a limitation as to how much they can lower rates. And yes, it is difficult for regular business world, but at the end of the day, that's not really what the Fed is concerned about. Of course, they say their mandate is, employment, blah, 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 blah. But they don't really have any control over that, because when you're bringing in mass numbers of millions of new workers, and that you're going to get wage pressures, which is ideal for employers, and uh, you're going to end up with greater unemployment. There's just no way around that. And the numbers are pretty clear on that. Corporations are always looking for cheaper labor. They're going to get it. At the cost of standard of living for those that are already here. So that's just the way it is. From an NQ, you can see we hit right up against that start of the algo on the NASDAQ, and it suffered. And, some of this was, the early buildup of AI and stuff like that, which we can see isn't probably going to be. This is what I talked about before, sort of like that same thing with the early dates of internet and stuff. It gets ahead of itself. From a practical standpoint, most people try AI and play with it for a little bit, and then they're gone, unless you actually are having some kind of innovative need. Uh, Hard to come up with useful applications from a regular individual standpoint when you're dealing with technical numbers and things like that, or formulas. It's helpful because they have access to everything, so that just makes it easier. But it doesn't really innovate or do anything new. It's not thinking; it's just regurgitating all the information that's available. It just makes it. It's like just having a giant encyclopedia, really, that can access all sorts of data that you would take quite a bit of time to find. So, in that sense, it just speeds it up. From a reading standpoint, when we look at this, you still have shorts fading out of the situation. So from that standpoint, this is just a failure of longs within that setup. You can see we got the orange beginning to make its dip and cross back below steel. So that's net positive. The shakeout breaking down into the negative, that usually tends to have more negative run to it. Of course, there's still the excitement of, Fed and what they're going to say out of Jackson Hole. I think that's probably going to be more muted than people expect. The bond market is going to be incredibly wrong because they're not going back uh, to the zero rates. They just can't do it at this particular stage. Now, if oil is somehow able to collapse and you have a significant like break on the economy to the point where it's stopped, well, then they might be able to justify it. But at the end of the day, they're way outside of where I think the Fed can go. And, it's problematic because, of course, people are going to say, yeah, I need lower rates to, stimulate growth. But people forget the early 80s and what it was like to have interest rates in the 13 plus range or even higher. And fortunately, the Fed understands that lesson, and they're way behind that curve early on, and they know it. But of course, they were responding to market narratives in a large order. When we look at oil here, it had a nice rebound, popping back up. Still, this is a much more reasonable area to fit within, and it's going to be helpful, particularly the longer it stays there. Certainly, definitely going to help soften inflation. Of course, the euro riding the tide of expectation that the Fed will cut, and that will make it more attractive to be in a euro. And of course, cheaper oil also bonus for that. So that's the justification within that rise. Not that the eurozone is actually productive in a way that's actually exceeding the U.S. Production still. Uh, these are the trades that have to take place in order to support global government. From a gold standpoint, took a beating on that, but again, also no real short activity. Is just going to be reset back and forth until it continues to make newer highs going forward. Even if you see a break, you would think that it should be trading counter to that, but the devaluation, and there's nowhere else to put the money other than in equities at this particular stage, and or as we've talked about, alternative stores of value, crypto, um, Bitcoin, and that still muted, given the fact that it's a pretty strong buy configuration within it. We didn't get the dip of orange below red, which is why it's been so soft. So there's still plenty of support for it, but just not enough to drive it at this particular stage into the new levels. And that could change depending on what comes out from the Fed and whether it meets the expectations or not. And I think that we're just going to continue to see this back and forth play, particularly until there's a bit more clarity as far as election situation goes, because that does have a huge impact that people don't always fully comprehend how much money is changed as far as where it goes, depending on who's running things. But is this convenient? Is it exact? Yeah. Previous algo area resistance, we caught up against it, we couldn't do anything above it. Well, as soon as it was recognized you couldn't get over that range, what do we do? Return back to the other previous one. These seem like unrelated and non-correlated numbers, but in fact they are, and they're specific to what the machine work is doing, and traded beautifully to it. And this was a representation of these MBI white spikes, and it was just a matter of waiting for that crossover move. And once it happened and MBI white moved above, you had that clear run, and there was no way that anything was going to hold. And we came all the way back to the zero. Yeah, pretty straightforward, clean. Uh, can't really complain. It's pretty simple to do the math on what that differential is. It was just under 100 points there, and filled it in, and now starting its way back up again in anticipation. And of course, this does beautiful things to options, because all those call buyers get killed, and the ones that got out of their puts because they were still underwater and got flipped around, and then new shorts add into the setup as we caved in literally from the opening buzzer all the way through. A little brief attempt at a move back up to the 50, but it wasn't sustainable given the MBI white spike that literally was right there. And then, of course, here in the post market, they're going to drive it up. So all those people who bought those puts will wake up, and lo and behold, they'll be worthless as well. And the cycle continues. So, pretty clean overall in general. There are really some difficulties uh, going forward, and I think the market is probably going to continue to get that higher sense of volatility simply because it's an election year. But the bias is still to push higher simply because of where inflation is at this particular stage and the Fed's unwillingness to actually tackle inflation, but to try and soft pedal it and hope. And it's kind of where they're at. It's a lot different than the 80s in that where you're looking at the relative debt comparison, so it complicates the issues. And it's not that they're over worried about debt simply because the world is just jammed with it. They're just going to keep pushing it down the road ad infinitum. So we just can play with what is and follow the readings, and that's all it takes. Pink Bar's been pretty clean with it. As always, learn anything relevant, I'll put on the Skype chat. Have a good one. Trade well.